We are currently witnessing one of the most deceptive setups in the history of the Bitcoin market structure. If you are looking at the price hovering around $68,000 and feeling comfortable, you are making a critical mistake. The order books across major exchanges are showing a divergence that we have not seen since the distribution phases of 2021. While the retail sentiment is screaming for a breakout to all-time highs, the institutional capital flows are telling a completely different story. You are being conditioned to believe that $68,000 is a secure floor, but the on-chain data suggests the foundation is much more fragile than it appears. If you are holding Bitcoin right now, understanding the difference between a bear trap and a cycle top is the only thing standing between you and a significant drawdown. Over the next few minutes, I am going to present 3 specific data points that explain exactly what the smart money is doing at this level. I will break down the liquidity heat maps, the realized profit metrics of long-term holders, and the derivative market leverage ratios that are flashing red. This is not about speculation or hope. It is about cold, hard liquidity mechanics. Let us get into the weeds. To understand the gravity of the $68,000 mark, we must first look at the exchange reserve dynamics. For the last 3 weeks, we have seen a steady stream of net inflows into centralized exchanges. Typically, when Bitcoin moves from cold storage onto exchanges, it signals an intent to sell, or at least an intent to use that capital as collateral for derivatives. The 30-day moving average for exchange inflows has hit a 3-year high, specifically from wallets that have been dormant for more than 6 months. The reality is that these are not day traders flipping coins for a quick profit. These are vintage coins re-entering the circulating supply at a price point that offers them historic returns. When long-term holders begin to distribute their coins, it creates a supply wall that demand must absorb. Right now, the demand coming from exchange-traded funds is absorbing a significant portion of this selling pressure, but it is not absorbing all of it. This creates a stalemate at $68,000, which many retail investors mistake for stability. However, stability at a high resistance level is often a precursor to a volatility squeeze. The market makers are currently pinning the price to maximize pain for both long and short positions before a decisive move. Here is why this matters to your portfolio. If the demand from the spot exchange-traded funds slows down even by 10%, that supply wall from long-term holders will crush the bid side of the order book. We are seeing the bid-ask spread widen on Coinbase and Binance, indicating that liquidity is thinning out. When liquidity thins out, it takes much less volume to move the price significantly in either direction. This is the perfect environment for a liquidity flush, often referred to as a bear trap. A bear trap occurs when the price is deliberately pushed below a key support level to trigger stop-loss orders. Once those sell orders are triggered, smart money steps in to buy the asset at a discount, rapidly driving the price back up. The $68,000 level is currently heavily leveraged. Open interest in the futures market has reached levels that are historically unsustainable without a correction. We are seeing billions of dollars in long positions that are leveraged 10 times or more. If the price drops to $65,000, it could trigger a cascade of liquidations. This is exactly what the institutional algorithms are hunting for. They need your liquidity to fill their massive buy orders. By forcing a capitulation event, they can accumulate Bitcoin without slipping the price upward. If this analysis is helping you see through the noise and stay ahead of the crowd, consider subscribing to ensure you never miss these critical market updates. Now, let us transition to the argument for this being a cycle top. There's a metric known as the short-term holder realized price. This metric tracks the average acquisition price of coins that have moved in the last 155 days. Currently, that price is sitting dangerously close to our current market value. When the spot price falls below the cost basis of short-term holders, panic sets in. These investors are not hardened veterans. They're often late entrants who are easily shaken out by volatility. If we see a sustained daily close below $64,000, statistically, the probability of a cycle top increases drastically. The last time we saw this specific alignment of the market value to realized value ratio was in April of 2021. Back then, the narrative was also overwhelmingly bullish, with calls for $100,000 per Bitcoin. Instead, we saw a 50% correction over the subsequent months. The reality is that market psychology does not change, even if the technology does. Greed drives prices up and fear drives them down. Right now, the fear and greed index is flashing extreme greed, yet the price is struggling to break new highs. This divergence is a classic bearish signal. It implies that the buying power is exhausted. Everyone who wanted to buy at these levels has already bought. Without a new catalyst or a flush of leverage to reset the system, The path of least resistance is down. However, we must balance this bearish view with the macro environment. Unlike previous cycles, we now have institutional giants like BlackRock and Fidelity actively marketing Bitcoin to their clients. This introduces a floor to the price that did not exist in previous years. These institutions are not buying for a trade. They are buying for a multi-year allocation. This structural demand is why many strategists believe any drop from $68,000 will be a bear trap rather than a cycle top. The supply shock from the recent halving is still working its way through the system. Historically, the true supply crunch is felt 6 to 9 months after the halving event. We are currently in that window where the reduced issuance of new Bitcoin starts to conflict with rising demand. If you look at the over-the-counter desks, the inventory is drying up. Miners are selling less because they need to hold for higher prices to remain profitable after the block reward reduction. This creates a scenario where a bear trap is the most logical outcome. The market needs to reset leverage, scare out the weak hands, and gather liquidity before making the real push toward $100,000. The whales know that if they push the price straight up from here, the cost of accumulation becomes too high. They prefer to engineer a drop, creating a narrative of failure to buy back lower. This brings us to the funding rates. Funding rates are the payments exchange between long and short traders in the perpetual futures market. For the past month, funding rates have been consistently positive. This means that long traders are paying short traders to keep their positions open. When this cost becomes too high, it becomes unprofitable to hold a long position. We are seeing signs that traders are closing their longs simply to avoid these fees. This selling pressure is subtle, but it adds up over time. It acts as a constant drag on the price, preventing it from breaking through resistance. If you are enjoying this deep dive into the mechanics of the market, make sure you join our community by hitting that notification bell so you are always informed. Let us look at the technicals on the weekly time frame. Bitcoin has formed a massive consolidation range between $60,000 and $72,000. This range has held for months. In technical analysis, the longer the consolidation, the more explosive the breakout. However, the direction of the breakout is never guaranteed. The relative strength index on the weekly chart is showing a bearish divergence. This means that while the price is making higher highs or maintaining high levels, the momentum is fading. This is often the smoking gun for a trend reversal. It suggests that the bulls are losing their strength. If we combine the bearish divergence with the thinning order books and the high leverage, the case for a significant correction becomes strong. But here's the nuance that most people miss. A correction within a secular bull market is healthy. A drop to $58,000 or even $55,000 would not invalidate the long-term bullish thesis. In fact, it would likely be the healthiest thing for the market. It would reset the indicators, cool off the greed, and allow smart money to reaccumulate. So, is $68,000 a cycle top? It is unlikely to be the absolute top of the entire cycle, given the institutional adoption curve. However, it is very likely a local top that will precede a painful corrective phase. The probability of a straight line up to $100,000 from here is statistically low. The market is too heavy with leverage and too exhausted from months of sideways action. We need a catalyst, and often a crash is the best catalyst for a future rally. It sounds counterintuitive, but destruction breeds creation in financial markets. The weak hands must transfer their coins to the strong hands for the price to appreciate sustainably. Currently at $68,000, the distribution is happening from smart money to retail. You can see wallets holding less than 1 Bitcoin are increasing rapidly, while wallets holding more than 1,000 Bitcoin are stagnating or decreasing slightly. This transfer of wealth is the hallmark of a local top. Smart money sells into strength. Retail buys into hype. So, what is the playbook for you right now? The strategy is patience and preservation of capital. Do not chase green candles at resistance. If you have cash on the sidelines, do not deploy it all at once at $68,000. Wait for the market to show its hand. Wait for the leverage flush. The real opportunity will come when the crowd is panicking, not when they are celebrating. Watch the $64,000 level closely. If that breaks, the door opens to $58,000. That is where the smart money has placed their limit orders. That is where the liquidity is sitting. The market is designed to transfer money from the impatient to the patient. At $68,000, patience is your most valuable asset. This is not the time for heroism. It is the time for risk management. The difference between a gambler and a strategist is the ability to sit on your hands when the odds are not in your favor. Right now, the odds favor a correction or a trap before continuation. Prepare yourself for volatility and do not let the market shake you out of your conviction if your time horizon is measured in years. However, if your time horizon is measured in weeks, the warning signs are flashing. This analysis is provided for informational purposes only and does not constitute financial advice. You must do your own research and consult with a certified financial professional before making any investment decisions. The cryptocurrency market is highly volatile and carries a high level of risk.